Ladies and gentlemen, many investors find themselves constantly pulled back and forth by two conflicting emotions. When stocks rise, they feel an irresistible urge to chase the rally, terrified of accidentally missing out on the entire upward trend. Yet, when stocks fall, they panic and rush to sell, growing increasingly anxious as prices drop, fearing their losses will only mount. The result is a perverse pattern. They hesitate precisely when action is most required and act impulsively when they should remain still. Today, we're going to clarify this matter once and for all. How can ordinary investors truly navigate the market's violent fluctuations and transform its ups and downs into tangible personal gains? My objective is to construct a comprehensive end-to-end investment framework to help you do just that. As we have discussed previously, the top 2% of investors never rely on market predictions to generate returns. Instead, they rely on a set of almost dispassionate principles to guide their interactions with the market. We have also dissected why, even when investing in broad market indices like the S&P 500 or Nasdaq 100, most people still fail to make money or may even end up losing capital despite having made the right investment choice. This is because the true determinant of your results is never merely the depth of your market knowledge. Rather, it is when you choose to buy and sell and how you adapt your investment strategy to suit the different stages of your life. Let's consider two hypothetical investors. The first, at the end of 2021, when the Nasdaq index hit an all-time high, judged that valuations were excessive. He chose to execute a strategic sell-off and moved into cash. The second, firmly convinced that the Nasdaq would continue its long-term upward trajectory, chose to tough it out during the sharp market plunge of 2022, enduring the full brunt of the market shock throughout the downturn. What would be the outcome? If we look solely at the current market conditions, the investor who held firm might appear to be the temporary winner. However, the real question I want to ask you today is this. Throughout that entire process, was your mental fortitude truly sufficient to withstand the strain? For many people facing this situation, the greatest dilemma is the complete absence of a clear objective standard to guide them on when to sell and when to simply wait. Over the past decade, the Nasdaq has delivered astonishing average annual returns exceeding 15%. Yet, hidden beneath those impressive figures lie deep drawdowns, market corrections of 30% or even 40%. Today's content is not intended to offer you specific advice on when to sell a particular stock. Rather, it aims to help you safeguard your capital amidst market volatility and transform your paper stock holdings into tangible cash flow. I will provide a highly specific breakdown of the optimal profit-taking triggers for the Nasdaq 100, as well as the objective criteria for determining when to re-enter the market. In the final section in particular, I will demonstrate how investors across different stages of life, from age 20 to age 60, must adopt entirely distinct asset allocation strategies. Today's topic focuses on the optimal timing for taking profits and the overall strategic approach to investing in the Nasdaq 100 index. First, we must clearly understand exactly what the Nasdaq 100, the subject of our investment, actually is. It is not merely a simple collection of technology stocks. Rather, it resembles a capital-driven survival race. Compromising the 100 largest non-financial companies listed on the Nasdaq by market capitalization, its core mechanism lies in periodic rebalancing. Should a company's growth stagnate, it is removed from the index and immediately replaced by a new innovative enterprise. If you were to compare the list of constituent stocks from 20 years ago with that of today, you would find them to be almost entirely different. This implies that we are not assuming the risk of any specific company, but are instead investing in the innovative capacity of the United States itself. From a long-term perspective, the Nasdaq 100 is more likely than most other indices to demonstrate sustained upward growth. However, this is where many investors fall prey to a misconception. They assume that since the Nasdaq tends to rise over the long haul, they can simply hold their positions blindly, completely disregarding the risks inherent in bear markets, and are guaranteed to come out ahead in the long run. But is this truly the case? If you had purchased the Nasdaq 100 at the very peak of the dot-com bubble in 2000, what would have ensued? How long exactly would it have taken to simply break even? The answer is a staggering 15 years. If your investment portfolio were to remain in a loss-making state for 15 consecutive years, would you truly have the fortitude to endure it? This constitutes the greatest pitfall of long-term investing. True long-term investing does not entail doing absolutely nothing. Rather, it demands active management, specifically within the bounds of one's own risk tolerance. Take 2022 as an example. The Nasdaq suffered a decline of approximately 33% at one point amidst a climate of extreme market pessimism. Those investors who employed a strategic approach, identifying clear oversold signals in the index, proactively reduced their positions, preserved their cash reserves, and subsequently bought back into the market in staggered increments once the downturn had run its course. Let us now examine a specific set of data to provide you with a more intuitive grasp of the Nasdaq's inherent volatility. Historically, the Nasdaq 100 has experienced a drawdown, a decline exceeding 30%, approximately once every 5 to 7 years on average. This is not a mere coincidence. It is a recurring pattern intrinsic to the market. To be specific, during the dot-com bubble of 2000, the maximum drawdown exceeded 80%. During the financial crisis of 2008, the maximum drawdown was approximately 50%. In 2020, it was roughly 30%. And during the interest rate hiking cycle of 2022, the maximum drawdown stood at approximately 33%. Research data indicates that when the market declines by more than 35%, 95% of ordinary investors choose to cut their losses and exit the market. In other words, fewer than 5% of investors possess the fortitude to hold their ground and even buy back during a major downturn. This explains why, despite holding the exact same Nasdaq index funds, the majority of investors fail to capture those long-term returns. You will observe a consistent pattern. The severity of a drawdown is not directly proportional to the time it takes to recover. What truly determines the speed of recovery is the underlying cause of the decline. Consequently, different types of market downturns demand different response strategies. Simply holding on for dear life indiscriminately is rarely the optimal approach. This brings us to the question that concerns everyone most. How exactly do we make these judgments? When should we trim our positions and when should we add to them? In fact, there is no need for complex charts. I will explain this in the simplest terms possible. Taking profits is akin to an agricultural harvest. You sow in the spring, the crops grow in the summer, and once they ripen in the autumn, you must harvest them. If you fail to do so, winter will arrive and the crops will simply rot in the fields. Taking profits does not imply that your initial market judgment was incorrect. Rather, it is a strategic move to convert a portion of your paper profits into tangible cash, thereby preparing your portfolio for the next inevitable downturn. Many investors struggle to do this, however, because they fear that the market will continue to rise after they sell. This is the phenomenon known as FOMO, fear of missing out. Yet you must understand that the probability of selling precisely at the market's absolute peak is 0%. The objective of taking profits is never to hit the exact top, but rather to lock in gains within a tolerance level you find acceptable. Even if the price continues to climb another 20% after you sell, that additional gain was never truly yours to begin with. It represents a premium earned by assuming additional risk. Chasing after that extra 20% can easily expose you to a subsequent 30% drawdown, a trade-off that is simply not worth it. Cast your mind back to November 2021. The Nasdaq was hitting new all-time highs almost daily. Stocks like Tesla and Nvidia were surging nearly 5% every session. Yet at that very moment, various technical indicators were already flashing warning signals. One astute investor decisively converted 20% of his portfolio into cash during that period. Consequently, when the market crashed in 2022 and others were panic selling, he was able to navigate the turmoil with composure, all the while positioning himself to add to his holdings at rock bottom prices. There are 3 key indicators you must absolutely keep in mind. First, when the relative strength index, the RSI, enters the 70 to 80 range or higher, it signals that the market has become overheated. At this point, you should consider trimming your position by 10% to 15%. Second, when the current price deviates more than 20% from its long-term moving average, such as the 200-week moving average, it's time to begin considering taking profits. Third, one must be wary of the tail end of an interest rate cutting cycle. The true risk lies in not the rate cuts themselves, but the subsequent phase, when the market has fully priced in the positive effects of the cuts and begins to shift its focus to the looming threat of an economic recession. Buying the dip is not merely about purchasing at a low price. Rather, it involves increasing your position size at a price point even lower than your previous selling price. It is a continuous process of systematically scaling up your holdings. The essence of investing lies in simultaneously lowering your average cost basis while increasing the quantity of your holdings. A crucial point here is to never fall for the common misconception that you should wait for the market bottom to be confirmed before buying. The true market bottom is always identifiable only in hindsight. It is impossible to pinpoint in real time. Therefore, the proper strategy is to predefine specific buying zones. Based on historical data, the Nasdaq typically experiences one correction of approximately 10% each year, and a more significant decline exceeding 30% every 3 to 4 years. Consequently, you can establish a set of rules in advance. Allocate 20% of your available cash when the index pulls back, 10% from its peak, allocate another 30% when it drops 20%, and allocate the remaining 50% when it falls 30%. When the price breaches its long-term moving average, a moment that often triggers psychological fear, historical data suggests that this frequently represents a prime buying opportunity. Furthermore, when market sentiment indicators plunge into the extreme fear zone, it often signals a golden opportunity to increase your position size. If you find yourself without available capital at such a juncture, it indicates that you either failed to execute proper profit-taking strategies earlier or that your cash reserves were insufficient, underscoring the necessity of consistently rebalancing your asset portfolio during normal market conditions. At this point, the broad framework regarding when to buy and when to sell should be clear. For individuals aged 20 to 30, the Nasdaq 100 represents more than just money. It serves as a tool for purchasing time. Your greatest asset is the 30 years of time stretching out before you. During this stage of life, the priority should not be frequent trading, but rather the continuous expansion of your overall position size. Don't be tempted to hastily sell off your holdings to fund immediate consumption, simply because you have realized a modest 7% gain. That seemingly small profit today could translate into a shortfall of hundreds of thousands or even millions of dollars in accumulated wealth by the time you reach age 60. Instead, view a declining market as a rare, life-changing opportunity, one that only a select few have the foresight to seize. As for the specific allocation ratio, there is a simple guiding principle known as the rule of 110. By subtracting your current age from 110, you can determine an appropriate allocation percentage. For instance, a 25-year-old could allocate up to 85% of their investment capital to growth-oriented assets such as the Nasdaq 100. At this stage of life, time itself serves as your greatest form of leverage. There is no need to take excessive risk. The power of compound interest will do the heavy lifting for you. For individuals aged 40 to 50, the role of the Nasdaq 100 should shift during this stage to become a source of stable cash flow. Rather than trading based on intuition, you should establish a systematic framework to generate a consistent stream of funds. By selling slightly more when the market rises and slightly less when it falls, you can naturally achieve portfolio rebalancing. At the same time, do not forget to always maintain a cash reserve. This serves as a financial safety net for your family, shielding your daily life from the direct impact of market volatility. So how exactly should you allocate your assets? During this phase, it is recommended that your allocation to the Nasdaq 100 be gradually reduced to approximately 50 to 60% of your total assets. Additionally, you should set aside a reserve fund covering 3 to 6 months of living expenses held in a highly liquid account that allows for immediate access whenever needed. Once you reach the age of 60 and beyond, stock price volatility may actually become a source of risk. At this stage, the priority shifts from capital appreciation to the generation of stable dividend income. You can gradually transition your growth-oriented Nasdaq 100 holdings into dividend growth ETFs or products utilizing covered call option strategies. Whenever the Nasdaq index hits a new all-time high, you should gradually convert 5 to 10% of your position, as the paramount objective during retirement is asset stability, not the pursuit of high returns amidst market volatility. After reading through this content, take 5 minutes to review 3 key points. How significant is the deviation between your average cost basis and the current level of the Nasdaq index? Where do market sentiment indicators currently stand? And does your asset allocation align with your current age and life stage? Finally, let us return to the initial question. Who emerges as the true winner? Those who hold firm during a market downturn or those who sell their positions prematurely? The answer lies with those who establish their own objective criteria and strictly adhere to those rules. Only those who place their trust in data and systematic processes can truly comprehend and successfully navigate the complexities of the market.